Hello and welcome back to the AV Team Real Estate channel. The Bank of Canada has made an announcement regarding its target for the overnight rate, the bank rate and the deposit rate. What this all means for Canadian real estate, let's take a look right after this. For the first time in a year, the Bank of Canada kept its policy interest rate unchanged based on this consideration of recent inflation and economic data, and therefore the benchmark interest rate is at 4.5%. To be fair, this wasn't unexpected. We heard from Tiff McClintock in January that they were signaling a conditional pause in March, although the bank is continuing its policy of quantitative tightening. This is undoubtedly good news for homeowners with variable rate mortgages and home equity lines of credit, who have had to deal with 8 rate increases that brought the prime rate from 2.45% at the beginning of 2022 to 6.7% today. The Bank of Canada overnight lending rate and the prime rate follow each other exactly. Global economic development have been broadly in line with the January monetary policy report outlook. While global growth continues to slow, inflation is coming down primarily due to lower energy prices. You know, that includes the gas prices. In the United States and Europe, near-term outlook for growth and inflation are both somewhat higher than expected in January. However, elevated core inflation is persisting and labor market remain tight. China's growth is rebounding and commodity prices have evolved roughly in line with the bank's expectations. In Canada, economic growth was flat in the fourth quarter of 2022, lower than the bank projected. The weaker than expected GDP was largely due to a sizable slowdown in inventory investment, while consumption, government spending, and the net exports increased. Restrictive monetary policy continues to weigh on household spending, and business investment has weakened alongside slowing domestic and foreign demand. The labor market in Canada remains very tight, with employment growth being surprisingly strong. The unemployment rate remains nearly historic lows, and job vacancies are elevated. However, productivity has declined in recent quarters, while wages continue to grow at 4% to 5%. Inflation eased to 5.9% in January, reflecting lower price increases for energy, durable goods, and some services. However, price increases for food and shelter remain high, causing continued hardship for Canadians. With weak economic growth for the next couple of quarters, pressures in product and labor markets are expected to ease, which should moderate wage growth and increase competitive pressures, making it more difficult for businesses to pass on higher costs to consumers. As for most, I'm not here to tell you that the market is rebounding and going to take off since the rate hike is on pause now, but we did witness house prices stabilizing for at least the past 6 months, especially in the York region. Like I said in many videos in the past, nobody could predict the market. We could only see the trend and the current activities. If we compare the sales from February to those from February last year, there is no doubt a big decline. We are talking about the peak of February 2022 at 9,028 sales and 4,783 sales in February last month. However, from month to month, we had the first increase from 3,100 sales in January to 4,783 sales in February. Although we can say that it is rebounding from just 1 month of data, trends do start with a change. Another big sign is that the days on the market for listing are much shorter compared to the early days when the interest rate hike was announced. People's psychology also plays a big part in buyers' behavior in the real estate market. With the recent decision from the Bank of Canada in which they conditionally paused the interest rate hike, that has to influence the buyer's decision as well. But I still wanted to emphasize that our fellow neighbor Americans are still looking to raise the rate because of the inflation number is still too high and there are no signs to slow down the rate. Our biggest enemy in Canada is unemployment, still at a historic low, so we still have a good chance to have more interest rate hikes in the near future. Anyway, I'm curious what you think about the real estate market in Toronto going forward and approaching the spring market, which is typically the hottest season for real estate. Do you think it will have a slight uptick or do you think it could go back down? This is a short summary of what is going on in the real estate market so far after the not so surprising announcement from the Bank of Canada that paused the rate hike. If you find this information somewhat helpful, please hit the like button, and while at it, consider subscribing to the channel. Feel free to reach out to me via the number on the screen or even book a call with me using the first link in the description below. You have a wonderful day and I'll see you in the next video. Bye.